Good evening and welcome again to the Wood Centre for the third in this series of Exit Right Talks for 2023. So we're kind of just over halfway through. I hope those of you that have been present or listened to the first two talks I found them interesting and engaging. I certainly have, and I think one thing I've picked out is just the amazing ecosystem that we have around here in this area, and particularly around the Wood Centre. So I've made some interesting contacts, and I hope other people that have been here have too, or if you've been online, that you've kind of picked up some nuggets from some really interesting speakers that we've had. Hopefully it's no different tonight. We have another double header, so we have two speakers who are going to present their thoughts and I think importantly their experiences of their kind of journey to exit. And around exits, relating to exits. So we've got two speakers tonight. We've got Gary Smith and Matt Brown, who Matt is the co-founder of, get this right, Corbett? Yep. Corbett, right? And Gary has also been involved to some extent with that journey, but Gary's also a serial entrepreneur, so has hopefully some other experiences to share as well. I'm not going to take up any more of your time, so without further ado, let me introduce the speakers. I think Gary's going first, followed by Matt. We'll probably try and save the questions for the end, but if there is a burning question in the middle somewhere, then I'm sure they'd be happy to take it too. So, Gary, please.
Yeah, so any questions? Just go for it. Okay, so clicker. Okay, so today, as you've been told, there's two of us. I'm the sort of the basic boring bit in the beginning, and Matt's going to give to you the real details about his business. So I'm going to go over some basics. We got introduced through Oxford Innovation. When was it now? In May of 2021, and my job in all this was to help Matt to get to the next level, mostly about raising some venture capital. Things, as you'll hear later on, changed and twisted along the way. It was a journey, which culminated, and I'm not going to steal too much thunder here, in Matt selling his business in 2022, which if you do your maths, you'll realize that was over a year. So my name is Gary Smith. My background is I'm a serial entrepreneur. I've been in the software industry for as long as there's been a software industry. My grey hair tells the story. I've had several businesses. Some have been successful, some maybe not quite so successful, but on balance, pretty good. I floated the first software as a service business on the stock exchange a number of years ago called NetStore. I've grown several businesses to reasonable revenues. I now spend most of my time not doing it so much and helping others. And so Matt's an example of that. So over the years, I've done 3 merger acquisition deals. I'm doing another one now for another client. I've raised over £50 million worth of venture capital for my businesses, and through my activities now, I'm helping others to do even more. One last little thing is a little plug down there, which is venturecircle.net. I've recently launched this thing. It's not really a profit thing. It's just to help founders to communicate with each other. So if you want to log in and join in, please do so. So okay, right. So the first thing is, so this whole presentation is about you're a startup founder. Should you grow the company? And what we mean by that is to go and raise venture capital or not, maybe grow organically, or should you up and sell it? So a question to the audience, if you could participate, that would be brilliant. So when do you think the founder of a business should start to plan for their exit? Any thoughts?
As soon as possible.
Absolutely right. You should start it before you start the business. Now, the reality is, and the reason why I say it began as a mistake is that, I might say this now, mightn't I, but the reality is, in the businesses that I've started, most of which I didn't really plan the exit at all in advance. And I think that may be the case here too. But the thing is that you need to do that to make sure that you're building a business, if you want to exit, if you're planning to exit at some stage, that does have the ability to exit. And I'll give you some feelings around that. Because the thing is that not all businesses are equal, and not all industries will give you potentially the return that you want. And so when you first conceive of your idea, make sure that you know that you treat the business in the same way as you might treat a product, a brand new product. So in a product, you're saying, will anyone buy this product? And then the same thing should apply to you when you're building your business. In the future, will anyone really be interested in buying this business? And what will they pay for it? And different industries have different dynamics. So here's an example of a client of mine. I've sort of hidden the names to protect them and me. And for the last 5 years, they've been in the restaurant industry in Southampton. It's 3 guys, actually, 3 young fellas. And they've got quite a nice restaurant. In fact, they've got 2. The dynamics of this industry are, it's a tough business to be in. Large amounts of capital, you've got lots of staff. They're often staff that are quite transient. There are very low margins. The upshot of all this is they actually get very low valuations, this industry, unless you become very big, and they're not yet. They recently decided to try and sell this business. You'll hear why in a minute. But the reality is they can't sell it. COVID probably didn't help too much. But nonetheless, valuations for that particular industry are really poor. So they're probably not going to get anything back for all the investment they put in. The same group, however, these 3 guys, whilst they were building their restaurant, realized that there was a bit of a gap around software to help restaurateurs manage the kitchen. And they looked around the industry and there was nothing there for to go and buy. So they decided to build, in their spare time, whilst running the restaurant, a software business. And the reality of the software business is that over the last 18 months, they've actually done very well. But on paper at least, their business is already worth in excess of £2 million. The thing about the software industry is that it's nearly the opposite of the restaurant industry. You don't need large amounts of capital. You might need it to grow rapidly, but you don't need it to get going. It has high margins, and you don't need lots of staff. The important thing here is they generate recurring revenues, and because of all that, they get high valuations. The message behind all this is that if they'd chosen from the I remember having a chat with one of the guys there, Kyle, said, but if you knew now, bit cruel really, if you knew now before you started the first business, why would you have ever gone into the restaurant industry? And he said he absolutely would not have done so. If it was a passion of his, fine, fantastic, but he wanted an exit. So the thing is this, and I've tried to be quite clever for the programmers amongst you. So if you have a choice, this is an if then else statement. If you have a choice to be in a different industry and you want to exit, then choose an industry with high valuations. Okay, right, so you've now got to the point, we're leaping ahead a bit here, where you decide to sell, and you're beginning to engage with a company or companies that might want to acquire your business. So this is a little bit about how the acquirer might view the negotiation from their perspective. So, surprise, surprise, what they'll be interested in is making sure that the valuation methodology they use is going to be lowering the value as much as possible to make sure they get a good price. So how do you go about doing this? And what they'll do is they'll say, well, look, let's assume you don't have any revenue. Well, all you have is a product. I can replicate your product. I'll just go and hire some programmers, and if it's a program, computer software, and so maybe it's 3 salaries for a year, and we'll have the same thing as you've already built. And so that calculation would be 3 times 75,000, assuming 75,000 is the annual salary for a programmer. A couple of $100,000, I've got what you have. So that's really minimizing what the value of that business might be. We'll come to the counter of this in a second. So if your revenue is weak, so you've got a product but you're still not really selling lots, then of course what they're going to do there is to use your last year's revenue as the anchor for them to put a valuation around your business. It'll be a multiple of last year's revenue. But if you've only just kicked off and you've only just really got the first few customers, that is not going to be in your favor. And the same thing applies to profits. If you're a high growth company, you won't be generating profits anyway. And so, because you're plowing your money back into the business, that's what the business plan is to do. So the acquirer may pick on that fact, use the fact that you have low profits, and use that as a mechanism to drive the price down. So your task, from your perspective, is to do the opposite to these things. So you want to drive the highest value for your business. So if your revenue is weak, well then don't use revenue as the driver for your valuation. Maybe take the product that you have and see what it's worth to the acquirer. And that is really important. So what it's worth to the acquirer, and we'll come on to the little details of this in a minute. The same thing applies to revenue. If your revenue is strong, then a good multiple of your annual recurring revenues, if that's possible, over the next 12 months. And if you have profits in high growth companies, as I've already said, try to avoid, even if your profits are okay, try to avoid using multiples of profits as a mainstay of the valuation mechanism. It might suit you, but for most people in high growth, it doesn't. So here's another example. So let's take this example of this software as a service business in the restaurant industry. And I've sort of changed some of the numbers to protect them a little bit here. But let's assume that their revenue, their pricing for their product is annualized at about £10,000 per year for each client they have. But they only have 30 clients. So their annual revenue for the whole business is $300,000 for the business. The acquirer are already in this industry, let's assume, and they've got a huge installed base of customers. Let's say they've got 30,000 customers already, all of which are potential customers for your product. So you can do a very simple calculation, which is to say, well, okay, so the value of my product alone in revenue terms to the acquirer is 30,000 customers times £10,000 per year. So that's 300 million extra revenue every year. And if they're doing 3-year contracts, then the contractual value of that is £900 million, a long way over the £200,000 that they might have said when they were negotiating with you. Of course, you can take it one step further and say, well, it isn't just what's the impact of that revenue to the acquirer? So they've got, let's say they're stock market listed, and that you figured out by doing your research that their stock market valuation, their market capitalization, is a multiple of their revenue. And if their multiple, let's say in this example here, is 10 times their revenue, then the extra 300 million that your product will bring to them is worth 10 times 300 million, which in that case is 3 billion. Okay, a long way away from the 200,000 that they might have said to you in the first place. This is really important. So, to be clear, it's unlikely as a startup you're going to get 3 billion for your business. But what it does is to help you in the negotiation. They will come up with something extremely low, and they're expecting you to cave because they're professionals at doing this. You've never done it before in your life. Be strong, and then just make sure that you can use this type of tool. This won't be the only tool to have a counter and something that's logical and they can't argue with. Okay. So the thing is this. So you may have assumed that the biggest return for your business is when your business is a little more mature. You've generated your revenues and everything else, and maybe you want to go through some investment rounds, and that's something I do all the time. There are some issues with raising venture capital because it comes with not just the money, it comes with some terms. And some of these terms are really important. And most founders focus in on one thing, which is what's the value of my company? And that is part of the story, but not everything. Because in the small print of the term sheet that you'll be offered, and if you then turn that into a major contract, it'll have things called liquidity preference shares, drag and tag clauses in the contract, good leaver, bad leaver. There's a lawyer sitting down here in the front who's nodding his head. Reverse vesting of shares. All these things, you need to go and research what they are. They make a massive difference to your returns on your company. So selling now, before you get into raising several rounds of venture capital, maybe you get a higher return on your exit than if you do it later. So let's take an example here. It's a rather complicated little table, and I'll try to talk you through it. So this is over time, and what we're trying to show here is that if a founder attempted to sell now, so they have no dilution from incoming investors, they have relatively modest, in this example, modest revenue of $250,000 a year. They have no restrictions from investors. There's no drag and tag. There's no liquidity preference. None of that. But when they come to sell it, maybe their $3 billion valuation or whatever the number turns out to be, the important thing about the yellow marker here is that it's a XX millions. If they raise now rather than selling, the reality is that a VC or an investor is likely to have a very different approach to how they would value your business. And in nearly every case I've ever seen, it's substantially lower than potentially you might get from selling the business to the right type of buyer. So when you kick off by raising a round of venture capital, it's likely that the value to the founders from that first round, remember you can't actually trade this is just on paper, will be a much lower number than you might sell the business for. So let's say you go through that example, you then go and raise the money, you decide to grow rather than selling out. And of course you're all there on the treadmill, okay? Because you're growing quickly. So what they're going to do, they'll expect you in the next 18 months to go and raise another round. And then maybe another round 18 months after that. The reality of that is, of course, is that all while you're doing this, the terms and conditions, those things I mentioned earlier on, mean that it's very unlikely you're going to be able to sell your business until the investor says yes. You may find someone that's willing to give you $100 million for your company, but if the investor says no, you can't sell it. And that's the issue here. So in this scenario here, you go all the way through the second raise, and the second raise may be, at that point here, the value to the founders, and remember, post-dilution, because by this stage they would have been, their shareholding would have been diluted by up to 45%, let's say, is about equal, in this example, to what they would have got if they sold the business today anyway, before all the investment. But even at that point, they're still locked in, because that investor is going to want 10 times the return on their investment. So in this silly example, it means that they'll have to take revenue from 2 million to 20 million a year. That's a big jump. That's a multi-year thing. And even then, you may need more investment. So the reality is this, is that if you're interested in exiting, make sure you understand the terms of the contracts you sign with the investors. So when to exit? Well, the reality is you can exit at any time. Right? You can exit with an idea. I'm sure if you're terribly compelling and the idea is big enough and you've got a good team behind you, but it's less likely. But if you have a product, we've already evidenced that. If you have very small revenues, you'll see later on, you can still do it. So don't worry about when, in terms of timing of the stage of your company. Think about what you're worth to potential acquirers. And potential acquirers come in all shapes and sizes. Some might be interested in what you're looking for is a gap in their armory. If it's the product, they've got like a portfolio, a pizza pie full of all their products, but they've got a gap. A slice of the pizza is missing. If you can fill that gap, and they have 30,000 customers and all the rest, then maybe there's a huge opportunity. Maybe they're a smaller business, and they're looking for revenue. You've got those revenue and profits. Fill the gap, find what it is. It could be that they're based in the USA and they need a UK operation. You need to fill the gap. Some of these will be worth a lot more to the acquirer than other parts. So in summary, choose, if you can, choose the right industry right from the get-go. Even if you have to sort of readjust your business midway, little pivot, make sure you understand who might buy the business and what valuations you might get. The other thing is there's no single value for your business at any given stage. It depends on who's acquiring your business or who is investing in your business. The same business might have 10 different valuations, all valid. Your job is to maximize that. So what you have to do is to make sure you understand what it's worth to the buyer at that time, and make sure you understand that when you take investment, you're locked in. It might be you're locked in for a long period and you're going to get dilution and they're going to take control. The bottom line here is, at every stage of your business, it's your job as founders to continually understand and analyze your options as far as exit. Thank you.
Thanks, Gary. Just a bit of corporate promotion here. So, my name is Matt Brown, and I now am Senior Product Director at UKG, which is the company that acquired Corbett back in November the 3rd last year. Just before I dive into the story, my story, Corbett's story, just want to explain the product. So Corbett is, although it's now called SWP as a module within the UKG suite. So Corbett is a strategic workforce planning platform, piece of software. And typically we work with large retail, hospitality, supply chain businesses, managing tens, if not hundreds of thousands of employees as a resource, and helping to efficiently understand how to deploy them into the business for how best to use them as a resource within the business. So our platform is a labour forecasting solution. So it's a modelling platform. It's highly configurable. There's no coding required. And it's used throughout the organisation to align business strategy around human capital. In terms of the journey, I guess, so I founded the business back at the end of 2016. My backstory is that I was a consultant, business consultant in this industry, in workforce management. I had been since 2003 or 4, thereabouts. Worked for a number of different enterprise software companies, worked in both Europe, Asia Pacific, in Australia, New Zealand, also for companies in North America. So I understood the industry and I understood the technology that was available in the marketplace. In my consulting, around 2014-15, we had a number of UK-based companies who wanted to have help addressing the medium to long-term planning of their workforce for financial budgeting, modelling purposes, and there was no capability that addressed that. So we started building spreadsheets, tools to help. They were very quickly adopted, and we realised that there was potentially a product play here. So we started building an MVP, minimum viable product, bootstrapped with our alongside consulting business, and carried that on through 2018, 2019, we were getting market validation by exposing that product to our consultancy customers. How does this look? What do you think? Does it address the needs that we're currently solving with all of these complex spreadsheets? Is it a better approach? And we did a sort of soft launch in 2019, but it was still very much a side gig. It didn't generate any income. It was a bit of fun. And I guess to Gary's point, I didn't have a business plan. There was no exit strategy. It was something to do. And then sort of towards the end of 2020, still just me pretty much full time in the business. COVID hits, started to get some traction with some interested customers, and that's where I sort of say the hustle. The product wasn't totally complete, but no product's ever complete, but it wasn't really ready to deploy. But it was just enough to attract that first customer who was a visionary, let's say, a stakeholder within a multinational sports retailer who saw the opportunity there. So we had a sponsor in that large corporation. They wanted to work with a new novel solution and be in at the early stages to help craft. COVID is on there because it killed my consultancy practice. All of our projects stopped overnight. And so it probably forced me and the others I was working with at the time to look at it as an option of, okay, well, let's give this a go. It looks like it's got legs. Around about the same time, I was introduced to Eagle Labs by the team at Codebase, who have a relationship with Eagle Labs. So we started getting exposure to this community here. I started looking at grants. Could I get grants from Innovate UK? What strategic partnerships are there out there in the market where our solution could form a piece of a bigger puzzle? But we landed that first customer around summer 2020. We then had a OS moment. How do we actually deliver this, stand it up? We've actually got a piece of paper here where we've contractually obliged to deliver this product, albeit the deal was really bad, but it was a deal nonetheless. And then towards the end of that year, Capital Enterprise is an ecosystem that I'd been plugged into, and they were running a funding readiness program. And I thought, okay, well, let's do that. I might be able to raise some money to boost the next phase of the company's growth. So that was kind of the first few years. I guess we've got to a point where we've got one customer. I've surrounded myself with probably 3 contractors to help deliver this. We've got a partner organisation in the Netherlands who's providing a bit of project management and customer facing to deliver this solution. Enter 21, the Innovate UK grant didn't happen. I had to go at raising funding on my own because I'd done the course, so I should be able to do it, surely. And actually, I nearly did. I had a few contacts, managed to have some conversations with somebody who was ex-retail industry, knew kind of what I was trying to do. Very close, but didn't quite get it over the line. We were still trying to deliver this first customer's requirements. They were stretching our product further than we were able to deliver. But I went and sold another one. So customer number 2 was one of my consulting customers. So again, leaning on my network, I guess. We got them onto the platform. They were a much easier customer to deploy. They were simple, I guess, in their requirements. So it was quite an easy fit. We knew we could deliver that, and that was very good, actually. We got some decent revenue. We deployed, and they've been very happy and stable. So that sort of plugged a funding gap for a bit. I then thought I'd have another go at Innovate UK. We teamed up with some academics from Henley Management College to look at how we could build some AI into the platform. We thought we had a really good chance this time, but it's very difficult to win an Innovate UK grant, I found out. So, and all the while, we're still trying to implement that first customer. They're breaking our platform. The technology doesn't work. So bringing in more and more consulting resource from externally. So how do we get to that next stage of stabilizing the platform, stabilizing our support base? How do I take the business to the next stage? Well, I sold to the third customer because I thought some more revenue might help. But actually, they wanted to use the platform in a totally different way, and it wasn't the way I sold it. So we then had to pivot slightly and develop a slightly different product than the one that we had and the one that I'd sold. But actually, that was very useful because it took us from a strategic planning application to one that, this is Costa actually, so one that is used in every single Costa shop within the UK and Ireland. So we'd gone from a central planning tool that's used maybe once a quarter or for fiscal planning, delivers value, huge value from its ability to release capital from areas that we weren't aware were funding overfunded, redeploy into other areas. We're now deploying that tool down into the shops to give the store managers on a week-by-week basis insight into how they should recruit from the marketplace to satisfy their short, medium and long-term resourcing requirements. So vacancies that are posted in the windows of Costa, that's driven from our platform, making recommendations. Should we be hiring temporary workers, short-term because it's a peak over Christmas? Or do we have a permanent vacancy here that we can fill with a full-time recruit? So that was really key to understanding where our product fits in the market, also releasing extra value in terms of value proposition and ability to talk about that and understand it as well. We then came across LIFT. So it's an internship program, part funded by the government. Again, that was through Capital Enterprise. And that allowed us to engage with the workforce. It was basically 50-50 funding to enable people who are looking for openings in all sorts of industries, but especially technology, to get their first opportunities. So we hired our first employees in 2021, and that was a major move for us to actually set up a payroll platform to take on the financial burden of monthly payroll, financial commitments. Obviously, then we need HR input, financial direction. So we also secured those. So that kind of took us to autumn 21. But partway through 21, through working with Innovate UK Edge, which is part of the Oxford Innovation community, who'd been providing me personally with a lot of support around marketing, understanding your product value and pricing. Because as I said, customer number one was a rubbish deal. So through that community, Gary was introduced to myself to maybe help with funding. How do we get to that next stage? And I don't know whether you remember, Gary, but we had our first meeting over Teams or Zoom, and Gary said to me, "Look me in the eyes, Matt. I want to see the balls of your eyes. Are you committed to raising funds?" And I said, yeah, of course. And so we embarked on this journey, the first piece of which we were reflecting earlier, I probably was close to walking away from because I couldn't see when we were ever going to get out of the planning phase. And that planning phase was building a robust business model. And I think there was a webinar that I attended within the Oxford Innovation community about how to build a financial model, which, all of these little things are really useful. But that 5-year business model and business plan was something we hadn't done. It was incredibly detailed because I like building detailed models, but that's something that was my day job. But I applied it to this, and we had a very robust way of forecasting our growth, our expenses, our customer acquisition. It also demonstrated why we needed investment because we had no scalable route to market. We had no sales machine, no way of talking to the market and to scale our growth. So that was the first piece of support and working and collaborating with Gary, along with this horrible thing called a data room, which is a whole bunch of documents, legal contracts, everything to do with your business that you just need in the background, just in case an investor says, oh, can I have a look at your XYZ? It's all there. So by the end of 21, we were kind of ready. And Gary says, okay, well, we need to move to the next step, which is executing a plan, all right? So we set about the fundraising campaign, the first piece of which is the pitch decks. So I thought I had a pitch deck from 12 months ago when I did it first time around. So I gave that to Gary and he pulled it apart and we iterated quite a lot. We also ended up with multiple versions depending on the audience or the purpose. So is it a teaser deck or is it a first meeting or is it aimed at angels or is it aimed at venture capital funds? So and then Gary put together a campaign which was basically filling my diary very methodically with continuous meetings and 15-minute prep sessions before every meeting to say, right, Matt, this is so-and-so, this is some of their background, we're using pitch deck 3, are you ready? Okay, right, we cut over and then deliver the pitch. So we became very polished. We were good at this, weren't we? And I remember the Oxford Investment Network, the Onion one was one of my best actually, where I was challenged. Normally I had 20 minutes for the initial pitch. I had, was it 4 minutes? I think 4 minutes. So I had to 4 or 5 and I had to scale it right down, but it worked. It was great. So we're busy executing this campaign. We land the 4th customer. And the business needs to carry on running, so we were busy redoing all of our marketing, our go-to-market strategy, busy recruiting more, and developing these strategic partnerships. So we are a point solution in an ecosystem where customers need a full end-to-end ERP solution. We're only one piece of that, so we needed to talk to other bigger players in the industry. About April, May time, I think we got our first term sheet. So this was from as a result of 4 or 5 meetings with this this fund, and it was really disappointing. It was it was a fraction. It wasn't even half. It was probably a third of the valuation. They still wanted all of the equity, so we were going to get far less investment. All of the factors that Gary was talking about, it took the wind out of my sails a bit. But nonetheless, it was a term sheet. It was our first bit of success, and so part of the trick here is to keep people warm. You never close doors. So that was our first term sheet. We then started to get some smaller check traction. So there are certain funds out there who do less investigation and due diligence, and they're quite happy to follow on and support. And so, you might put them together with some angel networks, and so you're sort of gathering more and more commitment to the raise. And around July, we got term sheet number 2, and that was actually quite nice. That was double the valuation from the first VC. Nothing had materially changed, but they just had a different view on the business, I guess. And interestingly, term sheet number 1, they weren't sat on capital ready to deploy. So if we'd gone with them, then I would then be rolled out to all of their investor community to raise the money. So that was first term sheet. Second term sheet was a more mature VC, but still it came with terms. They wanted preferential shares. So if we exited, they wanted all of their money back first before we got any dibs. We, as a founder team, had to start from zero again and earn our equity back over a number of years. There was drag and tag clauses, all sorts of terms that made it challenging to accept. Partway through this process, one of the larger players in the ecosystem, these strategic partners, we were talking to them about formal partnerships, and I got introduced to their head of corporate development. So I don't know what that person does, but sure, I'll have a chat. And it turns out that that's the department that is responsible for acquiring businesses. And I wasn't prepared for this. My mind was singularly focused on the fact I need to grow my business, I need to raise investment. So I kind of dismissed the conversation outright. I said, it's very flattering, but I'm not ready. I've still got my journey to complete. So thanks very much, but we'll carry on talking about partnerships, and we're going to go and raise venture and grow independently. So we've got our second term sheets. It's looking pretty good. We've also got a group of angel investors, smaller funds who are willing to support a lead investor. So we then get some lawyers involved and ask them to have a look at the term sheets. And we negotiate with that second VC. And you can do that. So we managed to get the valuation up. We managed to get some of the terms tweaked a little bit in our favour, but small wins. Now, whilst this is all going on, we had another one of our strategic partners came knocking and said, "Oh, how about coming and joining us?" And so Gary and I have this chat. What's going on here? We're trying to raise money, but on the flip side, we've got some of these partners who are talking to us about acquisition, and now we've got two. Maybe we should actually look at this seriously, because there's demand, there's interest in the market. We've got some term sheets that if we execute, as Gary was saying, as a founder team, we're locked in for the next, 5-10 years. It's hard work. You make sacrifices to keep running a business, and the returns, they're not guaranteed. We've got some interest now. Should we have a look at this? So, we went back to those two. We made them aware that there were other parties interested. We then got a third, which is slightly different. So the third one was a deep tech company who was interested in a vehicle to for their technology to live in an industry vertical. So they saw the success that we were having in retail. Could they put their technology and their IP into our vehicle and prosecute an industry that they'd not tackled before? Very different offer, but also structure and quite interesting. So there, all of a sudden, we've got letters of intent from acquirers. We've got term sheets from VC companies, and we've got a major decision to make here. Part of the challenge was with the letter of intent, they want everything else to be locked out. So if you start talking to us about an acquisition offer, we want 30 days exclusivity. Well, that's fine, but if at the end of those 30 days this is going nowhere, have we just burnt 12 months of work on fundraising? So part of the negotiation, part of the tactic there was to get the letter of intent adjusted to allow us to carry on with our VC project in parallel, so that we weren't closing doors. So, as an investor, that's not really what you want to hear, is that someone's also in parallel looking at an acquisition. But you've got to do the best thing for your business at the time. So as I say, we engaged lawyers. We are negotiating with the different potential acquirers about the terms and the structure of the deals, and whether or not to enter into due diligence, which we ended up doing. So at the end of July, I think it was, we entered into due diligence with our preferred offer, our preferred partner, and the due diligence and the legal process begins. Now, why did we go for that offer? It was actually not the largest number. It was the number that, or it was the partner that we felt was a better fit for our business and was more straightforward, I guess. So as it turns out, it was definitely the right choice. We have now found ourselves a very good home. But through that DD process, we're still negotiating with the VCs. We're still trying to gather the rest of the funds to complete the round, just in case the other option falls through, okay? So all in all, the DD, which was originally intended to be a 30-day exclusivity period, let's crack on, get it done, it ended up taking 3.5 months. It was incredibly long in every way, but the amount of depth that they went into the business, I think, the initial DD requests we had maybe 500 specific individual questions in all areas, technology, legal, customer, tax, finance. I think we got to about day 25, and I felt really guilty about the funding stream, the investment stream. So I'm not sure we were aligned on this one, but I felt I had to do the right thing for my conscience. And so actually I picked up the phone to the lead investor and told them what was going on. And they were really excited because it validated their strategy. It validated their investment decisions, that they'd gone through investment committee, they'd looked at the business, they'd looked at the people, and they put their backing behind us. And sure, they were disappointed that maybe they were going to lose out, but they were very happy to stay engaged and to carry on supporting us through to the end. And the people is one of the other main aspects for the acquisition, actually. So, we'd closed the deal at the end of, the 3rd of November, end of October, 3rd of November last year. So we are now part of UKG, which you probably haven't heard of. They're an American corporation which is formed through the merger of two large software companies about 18 months ago, Ultimate Software and Kronos, and they've called it the Ultimate Kronos Group, UKG. They're about 15,000 employees. They're one of the largest private software companies in the world, but not many people have heard of them. And we've been kept as a standalone unit within the business because they see the value of our product, but also our innovation and our ways of working. So they don't want to change that. So we're tasked with carry on doing what we're doing. We now have access to their global sales and marketing platform. Effectively, we're a suite play. So our product cannot be sold standalone now. It's part of it's a module within their suite. And if you think about what we set out to achieve through our funding round, we were aiming to grow the team. We're now double the size we were in November because UKG's invested in us as a team. I still run that business. We have our own separate cost center, profit center. We have a lot of freedom to carry on innovating. So we've ticked that box. We also wanted our technology and our product to be successful on a global stage. There is no way we would have had access to the market potential and the sales machine by building it ourselves under venture capital. So when you think about the reasons for exiting and why companies would acquire a small startup, personally for me, we now have the best of both worlds because we're de-risked. I don't need to stress about payroll, cash flow. The team have got amazing, terms and conditions. It's a great place to work. They've got great career prospects, but the product and our kind of founder legacy has a huge potential now to be successful on a global stage because of the home it now has within UKG. So kind of that's the journey through to not the end, but just the next chapter. So, I'm having a great time actually. I've got lots of freedom. I'm still responsible for innovating and growing our product, but there's so much more within the UKG suite than just our product, and so there's opportunities potentially beyond the Corebit application. But so for now, I've got plenty to do. We've got an integration challenge. The deal was about bringing the technology together, not about the market potential. So there's no pressure around delivering sales or traction. It's about bringing the technologies together, and yeah, the sales will flow. So in terms of my learnings, this process, I didn't enter into it knowing what I was letting myself in for. I did not have a plan. It kind of evolved. It's very tough, but it does pay off to keep going. It's definitely way more than a full-time job. That's for sure. The campaign design, the planning, the messaging is absolutely key. So we'd got 3 great customers, but we hadn't really refined any kind of market message. Certainly the strategy around fundraising, it was not there. So doing that is critical, but also be comfortable when plans have to change. It doesn't matter whether we're talking about product plans or fundraising plans. Plans always have to change. Cap table and corporate structuring, the shareholding and how you structure that's a whole nother topic, but it is very important to get right. And as we talked about in a number of terms, the deal dynamics and terms, especially tying you into the long term, the value, who's got control, all of that is critical. But I think most importantly is, surround yourself with a great support network. And this community here, I don't think this would have been possible without the people, a lot of whom are in the room here, maybe some online. But I'm very grateful, and it wouldn't have happened with the people who I've met along the way. So thanks Gary, Nikki, Wendy, you know who you are. So thank you.
Ooh. Thank you very much, Gary. Really fascinating story, and the detail was great too. So I love that, and I love the way the bringing in Gary into that as well, and seeing it from the sort of 2 sides there, and maybe a little bit of tension touched on there during the journey. But I guess that hopefully the outcome was positive for everybody. Questions. I think we've got a couple of online questions, or maybe 1 or 2. So we're going to get those first. Once Matt's asked those questions, if those in the audience want to ask a question, if you grab the microphone, please.
Thank you both. So question online we got here. So could each of you offer some insight into the process for approaching or getting an introduction to any potential acquirers? So what makes a good strategy?
I'm not sure about strategy, because as you can see here, this was organic, I guess. The campaign evolved as it became obvious that there was interest and also competitive interest. I guess for our situation, we could have identified, and we probably did a little bit in advance of it happening, that we were operating in an ecosystem where we had something that the incumbent established players would be after. So there's an obvious opportunity there. In terms of finding the right people, that was introductions.
Yeah, from my perspective, it's most businesses sell from a startup. Most businesses fail, but within 6 to 10 years, if you're going to sell, you're going to sell, and most sell through contacts you already have. So there'll be reseller partners or suppliers or something like that where you've already got, and it's your responsibility as founders to seed those relationships on reflection of your plan, right? So yeah, it's important to start to seed those things in way before you may want to sell.
Thank you. And Matt, did you ever feel like it might all fall through despite having multiple options on the table?
Oh yeah, definitely. Yes, there was a point where, there were several points along the way, but the stress and the pressure of the legal process and some of the decisions that we had to make was intense. And I can remember at one point we thought that it was not going to happen, and by that point we'd closed the door on our funding round, so or funding options, let's say.
Whilst racking up a huge legal bill that you still have to cover if the deal doesn't go through.
Yes.
I have a question for Matt, please. When you mentioned in your final slide about the cap table and the corporate structuring, can you kind of elaborate more on what sort of advice you would give to a very early stage startup? What sort of things they can do in order to plan ahead in for the regarding the corporate structuring things?
Yeah, so I guess my main points there are around understanding how some of the tax rules in this country work for benefiting individuals versus businesses. So if you're holding equity in different structures, that way it has an implication further down the road. And then some of the relationships that or incentives that you might want to set up around different share classes to engage other people coming along later in the journey. That's also interesting and important. And then you need to start looking at your articles of association to make sure that it all ties up together with how you want different actions and reactions to play out. Model articles are fine to start with, but at a certain stage you need to revisit, depending on how you're structured.
If I can add to that, so don't be too elaborate, is what I would say. I mean, I've have clients now and have had clients where they've really thought they were clever, and they set up their company in the British Virgin Islands, and investors typically don't really like that. So just be careful not to be trying to be too clever about the structure purely for tax reasons. Make sure that your investors are going to see this as something easy for them to do as well.
Any more questions in the room? I know I've got a couple waiting, but
Matt, just to take it back to the human level, can you comment on the emotional journey when you take your startup and slot it into a bigger, broader, wider entity, and then you hand over your baby, your pride and joy product, to be sold, supported, delivered by a whole bunch of other people you don't know?
Mm-hmm. So it was interesting when preparing for this tonight. It's the first time I've really dredged through the history and the sequence of events of last year. I kind of it was exhausting, and so when you come out the other end, you just look forwards. What I would say is, part of my comment and reference to us having found a really good home is that UKG, they've grown over the 20, 30 years through acquisition. They know how to do it. They know they do it very well. They're set up to make that integration process easy. As a small team being kept together, that also made that super easy, because the rest of the team carries on that journey. I'm the one that's exposed to the wider organisation, and so I take a bit of a hit, I guess, in terms of trying to understand how the wider organisation works. But the future prospects for my baby, as it were, are just so positive under the new ownership that there's. I think it's only it's only positive. I do find a little bit sometimes that I'm too far removed from the detail now that the team's growing and will continue to grow. But that would have happened whether we were going on this journey as a standalone unit or as an acquired unit. So I'm very happy to say that I'm having a very good post-acquisition experience.
I think we've probably got time for one more question, so sadly I'm going to miss out. But
well, I was going to ask
Go
about
ahead.
tie-ins,
Mm-hmm.
as to how different the expectation was from VCs as distinct from the acquirers that you were talking to.
tie-ins in what sense for me or the founder team?
Yeah.
Yeah. So I think it's probably fair to say that the tie-ins from a founder, from a fundraise expectation from a venture capital investor are all the way through to the point in time when the business exit and the investor gets their money back, albeit some of the terms on those term sheets allow them control to get you out of the scene if they so decide. So one of the downsides of that route with VC is potentially you could find yourself being exited without any upside at some stage if they decided that they want to bring in new leadership. So yeah, most of the time, those investors are looking to you and your team as the vehicle to take the business forward and grow it. And so, yeah, you're in there through to their 10x return, however long that is. Do you agree?
Yeah, I mean, it's everything about the term sheets you'll get from a professional VC is to make sure they're investing in you at a very early stage. So you and the team. So they want to lock you in. And so they'll do everything in the agreement to make sure that you have an incentive to stay and a big disincentive to leave. So, so on balance, there's always, when you're acquired, there's always a period that you're still locked in for a bit. It may be 18 months, something like that, depending upon the deal. But with a VC, it'll definitely be 4 years. I mean, the reverse vesting schedule alone that I touched on, it will, you think you own all your shares. Well, the VC says it thinks otherwise. And so what they'll say is that, yeah, you do own all your shares, but if you leave any time over the next 4 years, then we'll pro rata get some back. So yeah, and of course, that isn't the end of the story, because if you're on the curve of growing your company rapidly, you'll do another round. And that VC then will do the same thing again to you, potentially. So you're then locked in. You may end up with a $1 billion business. You'll end up with less than 10% of your company, but it might be worth it. But along the way, you've not had any real control of what happens to you.
I think we probably need to end it there. Actually, we're kind of running over a little bit, and I know there's an online audience probably that are about to switch off. So thanks very much, Gary and Matt. Really very interesting, and as interesting, if not more interesting than our previous speakers, but I'll let you judge online. You can watch them all. As I said at the beginning, this is the third of the 4 events for this year. So the next one is coming up in 2 weeks. So if you haven't already signed up for that, please register, and it promises to be as interesting, if not more interesting, next time. We've actually got 3 speakers lined up next time, so I'm not going to introduce them because I can't remember their names ahead of time, but hopefully that will make for quite an engaging and dynamic event, and maybe bringing in some conclusions from what we've picked up from the 3 events that we've had so far. So yeah, please check that out online. If you haven't watched the previous events, you can get them, and you should probably get a link to those from signing up to this event. So thank you very much for joining us tonight here in person. If you're here in person, there's some drinks outside. Thank you online. And yeah, thanks very much to our speakers again.